Good afternoon. It's April 19th. Michael and I are recording our spring 2024 market update. Michael, how are you doing today?
How you doing? Good, Kevin. How you doing?
Doing well, enjoying the spring weather and
Oh yeah,
just had the Masters and looking forward to what the next few months have in store for us and here in Nashville.
you were just at the Masters. I'm jealous.
Yes, yes. Well, I just want to introduce this market update. So we've titled this one, Why Equities Have Crushed It and How to Not Get Crushed in the Process. And we kind of just want to give an update like we do, every quarter. And hopefully you're hearing from us and what's going on in the market. There's obviously a lot of distractions like we always talk about. So hopefully you'll find this educational, informative, and kind of just continue to help you as an investor with a lot of the volatility we've experienced. So Michael, why don't I just start there and kind of ask you, maybe I'll just ask, hey, where is the market right now, and what are you seeing out there?
Yeah, it's a great question. We always want to take stock of kind of where is the market right now. This is a really good 5-year view for those of you watching the video and not just listening. Over the last 5 years, you kind of see that top navy line. Large cap stocks are up 92% over the last 5 years. You can see over the 22. We went through some of this on our last market update back in January, but what 2022 took away, 2023 gave back, right? And then the market went up in 2024. The Standard & Poor's 500 index, which is kind of our large cap index benchmark that we use, it went up about 10%, and right now it's off about 4%. There's a few things going on. The market's again trying to figure out what's the Fed going to do with interest rates. The Fed doesn't really know what they want to do with interest rates. They don't have an opinion. They're trying to figure out what's going on with inflation. So as the market is concerned about the Fed is concerned about inflation. So there's a little bit of a process there that we're working through with the market right now. But I love this 5-year picture. You can see small caps and international stocks have not done quite as well as large cap over the last 5 years. Fixed income bonds are about flat, down 1% over the last 5 years. But I like this 5-year view. It's still a relatively short-term view. It includes over there in the far left, you can see, that first little incline. That's before we knew what COVID-19 was, or that it was going to be a thing, and a big thing, obviously. And then the decline, and then the rebound, and so much money being pumped into the economy, for good reason, maybe, or some would argue. But then the Fed having to kind of get some of that money out of the economy by raising interest rates. That's kind of what we had to deal with in 2000. The market as investors had to deal with that in 2022. So it's been a nice rebound in 2023. 24 has been nice so far. So we'll see. I think it's also important, Kevin, just to understand where are we, not just in the short term, but where are we, what's the long view? What kind of market are we in? Because you could argue there was a short-term bear market in 2020. You could argue there was a short-term bear market in 2022, and both of those statements would probably be true. But the long term, really since March of 2009, 16 or 15 years ago, we really entered the next long-term bull market. And long-term bull markets, historically, the last 3 have all lasted around 25 years. So again, we're 15 years into a long-term bull market. That's the number one reason why the market has gone up way more often than it's gone down over the last 15 years. And it's important for investors to remember that a short-term bear market inside of a long-term bull market is a very different thing than, say, a long-term bear market. The last long-term bear market we had was essentially the decades of the 2000s, really 2000 through 2008. And that's not what we've encountered, really. The market has not behaved like that since then. Still some volatility, which we'll talk about that in a second. But this is why you don't, just because of 2008, some investors will remember that. It's hard to believe that was 16 years ago now. But the reason you don't sell your equities just because the market is volatile is, and this is a chart that goes back to 2010. So just after the long-term bull market started in 2009, large cap stocks are up 467%. Small cap stocks are up 318%. I mean, you can see those are the reasons why you really want to stay the course. It makes me, Kevin, I'll say one more thing. It makes me think that of this very famous quote, Warren Buffett's longtime business partner, Charlie Munger, who passed away last year. He was vice chair of Berkshire Hathaway. He said the first rule of compounding is never to interrupt it unnecessarily. So I think that's a very applicable quote for investors who've been through, mostly good times the last 15, 16 years. Certainly some volatility over the last 5 years, like we just saw, but certainly a lot more good than bad.
Great, thanks, Michael. Just one other thing, I kind of, maybe to segue from there, I just kind of want to see, what do you think would be helpful for investors to be thinking about right now? I mean, even, obviously we are both investors for our own portfolios, but for either our retired clients or our clients who are still working, what do you think or what would be helpful for people to be thinking about, or what do you recommend people be thinking about?
Yeah, that's a great question. I think there's a couple things. Taking Charlie Munger's quote and applying it, some data to it. Here's kind of one thing to think about. If you looked at the S&P 500 index, and by the way, we just sent a great newsletter for those of you that are clients and who get our newsletters. We sent a great newsletter just a couple weeks ago about the S&P 500 and how that's not really the entire part of an ideal portfolio, and kind of the pros and cons of that. And we'll touch on that here in a second. But if you do look at the Standard & Poor's 500 index, which is just a benchmark, which is essentially a weighted average of the largest 500 companies in the United States, and you just looked at the last 20 years of performance, you'd see kind of over here on in the top left of this chart that the average annual rate of return is right at about 10% almost. And yet that very next bar over to the right, if you just missed the 10 best days in the market, then your return over that 20-year period was almost cut in half. You earned 5.5%, which means you would have barely earned more than inflation. And then if you miss the 20 best days, over a 20-year period, then now you take a 10% return and you cut it by more than 2/3. Now you're not even earning 3%, and you're not even beating inflation, which is really, really, really sad. You can just miss, over to the far right, you can go to the, somewhat of an extreme and say, well, if you had missed the 60 best days out of 20 years, you just missed 2 months of really good days. Then you go from a positive 10% average annual return to a negative 4.3% average annual rate of return. So the healing effects of time is very important, especially when the market's doing better way more often than it does poorly. Here's another great slide that I think is helpful for investors to remember. I think it's relevant to your question, Kevin, is if you go back to 1927, again, Standard & Poor's 500 index data here, the average annual return is still at about 10%. And yet over this almost 100-year period of time, it only earned even close to 10%, like 6 out of the last almost 100 years. So it's less than 10% of the time that the market actually gives you the 10% average. It's very, very seldom. The greatest 1 year ever on here is 54% increase, and the worst 1 year ever is a 43% decrease. So if you're just kind of looking at 12-month periods. And so it's important to remember that, there's going to be volatility. It certainly makes us think about this one quote from Howard Marks, which I think is great. Like, no one worries about or minds experiencing volatility to the upside, right? Nobody really cares or minds or is bothered too much by a 54% increase in the S&P 500. It's a 43% decrease. And so that's why equities have to be viewed as long-term investments, and you have to have enough cash or conservative investments, maybe inside of a 5-year window. We would define long-term not as 20 years plus. The way we typically will define long-term is 5, 6, 7 years and greater. But no one worries about experiencing volatility to the upside. We only worry about experiencing volatility to the downside. But both up and down can be volatile. It's important just to understand market behavior and the history of market behavior, because as Winston Churchill said, the further you look back, the further forward you can see. And that's why we look back so that we can understand the behavior, what we expect the market to do going forward.
Great. Well said, Michael. Thank you. Yeah, I think a lot of us think about volatility as, only negative, right? It's hard to think about it at the upside. So I love that quote. Speaking of volatility, do you think, or maybe even why, are investors still surprised by volatility, even though it's so consistent and so normal? As you said, going back almost 100 years now, it's so consistent, so normal. So why do you think it still surprises investors when we have so much volatility?
Yeah, it's a great question. I think probably our clients, for those of you listening, I mean, our clients have done, I think, spectacularly well, not just in the last couple of years of volatility, but even through 2000, the volatility in 2020. We started sending out a significant, we made a significant investment in our investor education about stock market history going back in 2007, right before the market got cut in half in 2008. So we've been at that part of our practice for about 17 years now, and it's paid off really well because it seems like every downturn we have fewer and fewer concerned clients. But I think it's just human nature, right? We all invest for the reasons that are on what we call the 62-year scorecard. This is kind of what we're tracking here is that over the last 62 years, the Standard & Poor's 500 index is up 76 times. Okay, that's without the dividend. The dividend by itself is up 33 times, and then CPI, what's CPI? That's the Consumer Price Index. That's inflation. So inflation's up 10 times. And so, really the majority of our clients are really retired, and they probably don't feel like long-term investors, right? But they do need retirement income, and they need that retirement income to rise or to be reliable. They need retirement income to be predictable, but they need it to rise with inflation. So to answer your question, Kevin, we need something very consistent, but which is retirement income in that stage of life, but we're trying to get it out of a portfolio that sometimes feels inconsistent, because it is. But the important thing is, as long as the asset allocation is managed properly, which is obviously something we do proactively on a daily basis for clients, what you can get is the benefit of this chart, which is a portfolio value or a large cap part of your portfolio that can be up 76 times over a long period of time, a dividend that can be up 33 times. It's really the dividends that's a very hefty component of someone's ability to withdraw retirement income. So it's important. You cannot say most other asset classes do not outpace inflation by this much. And so it's important for even for people in the retirement stage of life to understand how much equities they really do need to own in the portfolio. It doesn't have to be everything, but Kevin, I think the answer to your question is we're trying to get something consistent out of our portfolio, like retirement income, out of a portfolio that sometimes will behave inconsistently. It's the inconsistent behavior of the portfolio value that's okay. It's okay for it to go down. The saying that we have around here on the Purifoy Well team, it's okay for a portfolio to go down. It's not okay for it to stay down, which is something we often review in market updates too. Makes me think of this quote from Warren Buffett, staying on the theme from Charlie Munger and Berkshire Hathaway. Warren Buffett said, "The stock market is a device for transferring money from the impatient to the patient."
Great. Thanks, Michael. So speaking of things that we can control, we kind of just talked about some things we cannot control, which is obviously the market volatility. Let's talk about some things that we can control and what you think is relevant to consider, maybe some factors even inside of a portfolio that would be really important for investors to be thinking about or know, because these are some of the things that are controllable, and obviously things that we're looking at for our clients every single day. But why don't you just talk through some of those things that we are looking at?
Yeah, in 2008, everyone's concern was market volatility to the downside, right? And then the hangover effect after 2008, which probably lasted at least 5 to 10 years, people were more concerned about volatility. That was the main fear. At some point, and this happened in the bull market of the kind of late 70s and then the 80s and the 90s. Eventually you got into the 90s, and the investor sentiment was not so much afraid of the volatility, because the last time they had really serious long-term volatility was the 1970s. You get into the early mid 1990s, the main concern starts to be not fear of volatility, but I'm afraid of missing out on some asset classes and their superior investment returns. This is a really great example because I think we're starting to see the early signs of that same investor sentiment. Again, you know, Winston Churchill and Harry Truman have made our market updates quite frequently, where Harry Truman said, you know, the only new thing in the world out there, the only new thing in the world out there is the history that you haven't yet read about. And so this chart, it's got a lot of numbers on here, but I'll just point you guys to the top right-hand corner where you've got large cap growth is the #1 performing asset class over the last 10 years. It's earned 16%. There's not another asset class on here that's earned 16% average annual return over the last 10 years. That's a big deal. Large cap growth is one part of the market. That's large cap stocks and companies that instead of paying out more dividends, they reinvest their profits into the company to go, you know, expand their ability to deliver services or goods to the consumer. But what we're also finding on this next chart is that part of the market is the most overpriced. It's according to a 20-year average of what we call a price earnings ratio, which is only one way. It's not the only way, but it's one way to measure our stocks over or underpriced. Large cap growth, by that one measure, you could argue that it's 47% overpriced. And so that's something you have to be really careful about. For most people who have well-positioned, well-allocated portfolios, your large cap growth fund or stocks have performed better than others. It's not often so much about certain stocks or stock picking. Most of people's, and this has been proven in case studies, most of people's investment returns are more about the class of the investment, not so much the individual investment. And so you could go even a little bit further and say, well, what's even performed better than large cap growth is you can just say, well, the NASDAQ has beat the S&P 500 over the last 17 years, and it's beat the growth side of the S&P 500. In this chart, you can see NASDAQ's up 9 times over the last 17 years, and the S&P 500 is up 4 times over that same period. So when you start to think about a well-rounded asset allocation, you're always going to have, let's say, technology stocks as one really kind of small example, because you'll find many technology stocks traded on the NASDAQ. Those are part of a well-rounded portfolio. But the danger is an investor can, because of the superior performance, can let those grow into a greater and greater and greater portion of the portfolio to where you get you know, too far from home, so to speak, with a well-rounded asset allocation. And what's the danger? Everything's, you know, been performing great. Well, the challenge is, again, you look back at history, what you see here is after the 2000 through 2002 bear market, it took the S&P 500 index about 5 years to recover. Same thing happened after the 2008 decline, okay? Both were about 5-year recoveries. Well, the NASDAQ, it took the NASDAQ 13 years to recover after the 2000 to 2002 decline. So with more risk or with more reward, oftentimes comes more risk. What does more risk mean? Just more patience that is required from investors. And that's where, Kevin, I think it's on us as advisors to continue to educate clients and help them clarify how patient they really need to be. Many clients listening to this today will, I think, appreciate this sentiment. They probably heard it from us before. We will never tell clients during volatile times of the market, hey, you just have to be patient. We may encourage them to be patient, but you can always, based on history, you can always quantify how patient an investor really needed to be. And I think that helps alleviate some anxiety, even though past performance is certainly no guarantee of future results. But you've seen enough repetitive behavior out of the market where you can start to develop some clues. We do this in other areas of life, the way we exercise, what we eat, the way we treat people in relationships, the way we work at our jobs. There are things we learn about life that encourage us towards healthy behaviors, and we become, because of consequences, we become discouraged towards unhealthy behaviors. So, Kevin, as you know, and as our clients have sometimes heard us, if we would apply the same life lessons to investing, we'd all really be better investors. So the point here is that you'd really like to know, even though past performance is no guarantee of future results, you can really start to get some good estimates on really how patient you have to be. Because it's really all about the financial plan and what someone's trying to accomplish.
Yeah, Mike, I think that's super important. You know, if you don't mind, I know we love history. If you don't mind, go back to that last slide one more really quick. Michael, maybe just for 30 seconds, maybe expand on this, because I think, you know, obviously, you know, around here we love history. We think it's one of the things that can guide us the most. But sometimes we hear this time's different. And I think, you know, there's a famous quote that says that's the most dangerous quote in investing, is this time's different. If you don't mind, maybe just 15, 30 seconds. What is your thoughts on when you hear this time's different?
No, that's great. And we touched on that in the last market update. It really is always different. You know, there's a couple quotes that I think about that really ring true for us. You know, Mark Twain said, history doesn't repeat itself, it often rhymes. You got you know, what we just referenced that Harry Truman said. I think the challenge for investors is that, you know, the news really is new. I mean, it is something new that happens, right? But what it is a repetitive behavior of something a human being did before, whether it's an invasion in a foreign country, another election. You know, I don't think the two presidential candidates are going to, you know, go outside a debate conference room and challenge each other to a duel, right? We've had political heat in our country. And this is obviously decades, centuries ago, where they would settle, you know, they would settle things with guns. The point that I'm kind of making is that, you know, we've had divisive election years. We've had volatility. The market only knows really two things, and it's the collective human emotion. It's either going to go up when it experiences less fear, and it's going to go down when there's more fear. And so the market is always right. This is a wonderful quote from Nick Lacy, who's a vice president at Raymond James. The market is always right. We just don't know why at the time. He might have taken that from someone else, but that's a really great quote. We just have to know kind of how it behaves. And again, that's why we don't want to put all of our money in NASDAQ, or all of our money in tech stocks, or all of our money even in the S&P 500 index. As long as we just know how it behaves, then we're protected. And because we do know that history, again, is going to have this very repetitive nature to it. So
great. Thanks for expanding on that. I think we can close with this. We have a quote from the late Benjamin Graham. He just says, the best way to measure your investing success is not by whether you're beating the market, but by whether you put in place a financial plan and a behavioral discipline that are likely to get where you want to go. So I think it's just super important to remember, you know, we can plan for everything, for the upside and the downside and the volatility. The main thing is making sure we have a plan put in place. So the good news is, if you're a client of ours, we're obviously watching this on a daily basis. Make sure your investments are well placed and managed. If you're watching this and maybe managing things on your own and would like a second opinion, obviously please reach out. But for our clients, you know, we're always a phone call away. We'll always be in the office working hard. And please give us a call if you have any questions about this market update or anything else going on in life. So thanks again for trusting us and partnering with us, and look forward to talking to you soon. Thanks, Michael.
Thanks, Kevin. Take care, guys. Let us know how we can help.